Welcome to EQ's Insights podcast series. Today we are joined by Paul Torre, President, EQ Fund Solutions.
Good afternoon, Paul. Thank you so much for joining us today. Closed-end fund market price discounts to net asset value have been at historic highs. How does the current closed-end fund environment compare to what you've experienced previously?
Well, good morning, Nancy. Thank you for having me. I think the biggest thing, as you touched on, is the discounts are at historic highs. But what also is fueling a lot of the activity out there is that there are larger, more sophisticated hedge funds that are in the area of buying up this closed-end funds at large discounts. When I first started in the business 30 years ago, it was more smaller, less capitalized companies, not quite as sophisticated. So today you see a lot larger larger amounts of capital coming into the marketplace with more sophisticated investors, such as the one who's making the most noise right now, Saba Capital.
It's great that you've mentioned Saba. Activists such as Saba have made a lot of headlines lately. Given their moves in acquiring positions, when does a fund become attractive to activists like Saba?
So what we have seen historically over the last 30 years is when discounts start trading at 8% or greater, it starts becoming attractive. We have seen a little bit recently where it's on more income funds that might be yielding a 6 to 7% return, where the discount starts trading at 6-7%. It's seeing more of the activists starting to jump in. So we're seeing them come in a lot sooner and coming in with larger positions than they have historically.
You've been involved with fund activists for many years now, given your experience. What would be the main motivation for these activist investors?
Well, at the end of the day, they see it as opportunities for them to make a quick buck. Sometimes a quick buck turns into a little bit of a longer play. The one thing that we've seen out there is that they are persistent. If you do defeat them in a proxy contest, it doesn't mean they're going to take their investment and go home. They do sometimes double down and come back for more. So they're to be taken seriously when they do start buying into your fund. They are not small-time players anymore, these people, and they're looking for a return at close to the NAV.
Can you talk to me a little bit about what you've seen could be called key themes and patterns that have emerged over the years with regard to these activists and where they've obtained the opportunity to realize gains from closed-end fund discounts?
Well, there's just a natural discount trading that happens historically over a lot of funds. The big thing I'm asked a lot is how do we keep the activists out of our funds? The simple answer is don't have your stock trading at a discount. Now the challenge is how do we make sure it doesn't trade at a discount? But one of the common themes that you just mentioned that we're seeing out there is there are certain triggers that make it advantageous for activists to jump into a closed-end fund to put pressure on a fund. And that's on the announcement of either a change of control in the investment advisor, and they have to go out and approve new investment advisory contracts, or in the case where one fund is selling their fund off to another fund complex, and they have to go through a reorganization change. So those are two triggers that definitely the activists are looking for and looking to capitalize on.
It's great that you mentioned triggers. I'd like to ask, because you've been in this business for many years, how can closed-end funds really address this type of activism?
The biggest thing is there are two things that I think are important. One is know who your shareholders are, and we help companies through a product called ID, identifying your shareholders, or shareholder ID. I strongly recommend every fund to be doing it at least at a quarterly basis. If not, if you don't want to do that, looking at once or twice a year. Whether there's activists in there or not, it's good to be doing that on a regular basis just as a checkpoint. What this does is it takes a lot of the public data, but we have in-house proprietary data that we utilize to give a real-time snapshot of who the shareholders are. A lot of the 13F filings can be as old as 3 months. By the time we're seeing it, the activist has moved in a lot bigger than had been perceived. So that's number one, is stay on top of who your ownership, who owns your shares, what type of investors are in there. And I believe it's a good corporate governance practice for all fund boards to know on a quarterly basis who the shareholders are. If there is activity in there, sometimes we will do monthly or weekly reports if there's a lot of activity, but on the basis of quarterly. And then the next thing is communicate with all of your large shareholders. Oftentimes, closed-end funds do not communicate out to their holders, and you kind of have two segments. You have your friendlies and your unfriendlies. The general perception is people don't want to be talking to the activists. They're the bad guys. But under the guise of keep your friends close and your enemies closer, it's always good to have some dialogue with them. I have seen fund companies that keep an open dialogue and ones that refuse to talk to them. And it works out usually for the better for those that have some open dialogue. So just adding to that, I mean, the behaviors of these activists, they are human beings, they're not robots. So they do take some stuff personally. I try and get my clients not to take any of this personally, that it's purely business. If the discount opportunity wasn't there, these activist investors would not be there. But it's difficult. I mean, we all take things personally, so it is a challenge.
How can closed-end funds ensure their specific control share bylaws are not changed or overturned from activist investors?
Well, the whole Control Act share is a hot topic right now because a lot of the fund families are opting in where it's not state law, and you have the activists who don't like that and are putting up a fight. They're doing it through proxy battles where they know they're going to get the support of ISS. ISS does not believe in what they perceive as entrenchment, and they believe Control Act shares there is entrenchment. And there have been a number of legal actions taken by the activists. So I don't think the answer is out there yet on how to resolve that, but it's another lever for a fund board to take, albeit it's a short-term lever. Ultimately, figure out how to eliminate that discount and the activists will be gone, whether it's working with the activists or not.
You've seen a lot of different situations over the years. What are some of the primary ways activists have tried to gain and then realize the discount to the NAV?
So there are a number of things. When the discount starts widening, they start buying in. So they traditionally were three things that they would look for. One would be a tender offer at close to NAV. So if they're buying at an 8-9%, they can get out at a 98% to NAV. The other one is an open ending of the fund where they get out at NAV. The third would have been a liquidation. What we have seen in the last 4 or so years in the case of Saba is that they have actually come after the fund itself to take over the management agreement and get the management fees. So that's a little bit of a new twist the last few years, but I would say those three, tender offer, open ending, or liquidation are the main ones that they're looking for.
You mentioned shareholder ID identification analysis. What specific information does EQ provide to fund managers that can help them understand what's happening with accumulations and what they can discern from that expert analysis?
Yeah, I think the big part is giving them more timely information on the accumulation of activists. I have been involved in a proxy contest going back a few years where we did win the battle that year. Suggested to the client that they should engage in an ID program, that the activist was not going to go away. They kind of put their heads down and went back to their day-to-day job. Fast forward 9 months later, the same activist launches a proxy fight. We don't have any fresh ID reports. They don't want to spend the money on it. So we're going off of dated 13F reports. We put together a strategy and vote projection off those. Little did we know, another kind of aggressive follower, I will call them. They won't start active fights, but they will follow the activists. They had accumulated 4.9% of the outstanding shares, avoiding a 13D or G filing, but fully supported the activists, and that was enough shares for the fund family to lose the battle. So had they known this information as this activist follower was accumulating the shares, they could have engaged that individual and hopefully worked something out.
So given all this that we've discussed so far today, is it better for fund managers to go head-to-head with the activists or try and work out some kind of strategy with them, given the state of the discount where it is?
So there are a lot of variables. It's a great question. The one rule I do have, though, is keep open lines of communication. As I said earlier, keep your friends close, enemies closer. But I don't think there's one solution in all cases. Bottom line is what we try and do is guide our clients in taking a look at the shareholdings, take a look at the vote projection where we think it's going to come out, and whether or not they need to cut a deal with the activists or not. We hate to see the activists get any type of deal on these transactions, but ultimately for the greater good, sometimes the fund has to work out a deal and deal with the devil, as they say, to get the greater good done. And I just had a client do that recently, going into the analysis, said to them, if you can get this one activist on board, it'd make it a lot easier. So they had conversations with them, and they were able to merge these two funds with the agreement of the activists. So, it's a business for both sides. So I think it's something that's definitely case by case, but I would not say one size fits all, where don't talk to them or do talk to them all the time and cut a deal. The big concern for a lot of funds is if they negotiate with them and get a deal on one fund, well, they're going to be sitting ducks to be, the perception is, well, we'll be easy targets down the road because we've negotiated once. So
thank you so much today.
You're welcome.
Final thoughts?
In addition to SABA and some of the other larger hedge fund institutions, we're seeing new ones starting to emerge. So we're trying to keep an eye on that and see if they will ultimately become players like SABA or not, but it keeps us busy. I think opportunity creates profit for some people, but we have to figure out a way to minimize that for these activists and keep the interest of the long-term closed-end shareholders at hand.
No, thank you.
Thank you for joining us for this episode of EQ Insights. If you enjoyed this show, please follow us on your platform of choice. If you would like to learn more about EQ, please visit us at equinity.com/US.